Uber Technologies Inc., ticker symbol Uber, is currently trading at $72.91 a share. If we go look at the stock over the last year, it's been a pretty bumpy ride. Highs of around about $87 and then lows of about $54. Over the last 5 years, though, this stock is up about 160%, which is easily crushing the S&P 500 over that time. What we're going to be doing today is looking at their most recent earnings and then taking it to my automated stock valuation spreadsheet to see if Uber is a buy or sell using the discounted free cash flow model, comparable company model, and Ben Graham formula for intrinsic value. So let's just put in the ticker Uber, and this will load all the latest company financial data so we can have a deeper look. If you're interested, check my Patreon. It's the $4 tier. This gives you full access to the sheet. But anyway, enough about the hard sell. So Uber Technologies Inc., $73 a share, market cap of $153 billion, a PE ratio of 15.9, which is a lot lower than the market average, which is currently around about 26.9. Earnings per share, $4.58, and a beta of 1.37, meaning it is more volatile than the market. Analysts do have it as a buy, target price around about $88 a share. Uber did not pay a dividend, so we won't be talking about that. So let's have a look at the revenues here. Ignore the trailing 12 months. We have the full year of 24, and it is just a drop under 44 billion. This is all-time highs. They've been increasing, had pretty exponential growth, apart from some downturn in 2020. We all know what happened there. And Uber has gone from strength to strength. If we do look at the most recent earnings, let me just scroll down here. We have the, just keep scrolling down. Yeah, so we have the year ended. 3 months ended here, which is the 2023 versus 2024, 3 months ended December. Trips up about 18%, 2.6 to 3. Gross bookings 37.5 to 44. You can see revenue 9.9 to 11.9. Everything is up. And then if we scroll down here, we can see the specific splits. This is on the gross booking side between mobility, which is the ride sharing, and delivery, which is Uber Eats, and then obviously their freight business. 23 versus 24, 19.3, up 18% to 22.8. Delivery 17 flat to 20.1, and then freight down ever so slightly, but not much of a difference. So overall, that is 37.5 up to 44.2. So everything is up. Things are looking good. Their main segments are growing, and are they able to generate more profit out of this? Yes, most profitable year ever. They were profitable in 18, then again in 23, and are now 9.86 billion in the green. Free cash flow, they're generating lots of free cash flow. All-time highs, 6.9 billion. And if we look at operating cash flow versus capex, you can see operating cash flow is increasing, capex is down. It's been pretty steady for the last few years. You can see it here was a big capex, slowly declining, but still a lot. And then eventually in 22, positive operating cash flow, and it's gone from strength to strength. Shares outstanding. They are issuing more shares, as you can see here. I mean, Uber is still a relatively new company. This is not uncommon. But yeah, hopefully in the future they'll be doing buybacks. But right now they're raising capital still through share issuance. So let's have a look at the discounted free cash flow model. This is where valuing stocks, looking at the future free cash flows and discounting today's volume. And let's see what it has here. So currently we have minus $5 a share. Obviously that is not correct, but it's just based on the averages here. So let's have a look at these numbers and see what we agree with and why it is a minus. So revenues, analysts are expecting around 50 and 58 billion in the coming years. We have it as 22% growth. I don't think they can sustain that. Let's go to 15, which is what we're seeing here, 50 and 58. Net income margins, now that they're profitable, let's go on the lower side on the most recent year, 22%. See, that brings us to $170 a share. But finally, net income to free cash flow. So let's just go with the most recent year and see what that gives us. Does have it about fairly valued, $76 a share. So yeah, discount free cash flow has it at about fairly valued, which is quite surprising for a fast-growing tech stock such as this. Ben Graham formula for intrinsic value. Let's see what analysts are expecting in terms of Uber growth. And 31%, that's quite high. Haven't seen that high in a long time. Puts it $150 a share. Very, very surprising. Ben Graham normally hits stocks because of the high inflation environment. But you can see here, $150 a share. So discount free cash flow model has it fairly valued. Ben Graham has it as a definite buy. And let's have a look at the comparable company model. Finally, this is the way of valuing stocks looking at their competitors. I mean, number one, we have to go with Lyft, ticker symbol Lyft. And then we'll look at DoorDash, which is Dash. And finally, we'll have a look at Airbnb, which ticker is Airbnb. I know not in a direct comparison, but oops, I've just put everything in bold. Very, very funny. And then we'll do Airbnb. Not a direct business, but certainly in the sort of online space. So let's see what we have here. Uber, largest by quite a bit. Revenue, most revenue. Second highest revenue growth rates. Only DoorDash beats them. And in terms of 1 year, you can see it's the third highest. Lyft and DoorDash beating them. EBITDA highest, net income highest. Second biggest margins. The other companies, now yes, they are newer in the life cycle. Very small margins. Hitting Airbnb, this sort of very high tech. Price to sales, second lowest. Price to book, second lowest. Peter Lynch's price to earnings growth. Ideally, you want this under 1. Lyft and DoorDash are. It has Uber's 43, which I'm quite surprised at. Let's just see if I can confirm that and see if it is correct, because that does seem quite high. Okay, fine. I'm looking at this in other wings. It does seem to be pretty high. So yeah, I'm surprised about that. This is the 5-year expected year peg. Okay, fine. EV to revenue, second, well, lower than the average. EV to EBITDA, way lower than the average. PE, way lower, and forward PE, so $300 a share. This is because of the PE ratios of Lyft and DoorDash, which are very, very high. Now, if we were to just compare, let's just switch this one here. We'll go Airbnb. We'll put Lyft here. And then compare it just against Airbnb because it's a much more mature company, whereas Lyft and DoorDash not so much. Let this load here. And also, actually, what I'll just do while that is loading, if we are to compare versus Airbnb. Last year, Airbnb is down 28%. 5 years, I'm going to do max. I mean, all-time Uber is up. Airbnb is not. So that kind of shows the difference in the two companies. Let me see here. So we do have Airbnb. Come on, slowly load. Come on, computer. You can do it. I believe in you. We'll just change this as well to Microsoft to get it to load. And then we'll do Airbnb again. Okay, we can start comparing now. Yeah, it has been a bit slow. I think it's because it's loading in 3 different places. I probably should change this. But we do have the numbers here. So Airbnb, lower EV to revenue. So it has it $80. EV to EBITDA is higher in P. So it does give us an average of about $76 a share, but this is because its EV to EBITDA is a lot lower. In terms of EV to revenue and P, it is a buy, but EV to EBITDA is quite low. But still a buy directly compared to Airbnb, but definitely compared to its competitors, which is DoorDash and Lyft, a definite buy according to the models. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon. Links are in the description. It's the $4 tier for the sheet. Like and subscribe, all that YouTube stuff, and I'll catch you guys next time.